Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas, and I teach Intermediate Accounting 1 and 2. And today's lecture is for my Intermediate Accounting 2 classes, Accounting 3120. And it's about income tax accounting, another really fun topic that can make your head spin a little bit. And today I'm going to be working problems. And I want to acknowledge the textbook I'm using and some of the materials I'm using from them. And it's the McGraw-Hill, Spiceland, Nelson, and Thomas Intermediate Accounting textbook. It's a great textbook. With that, I'm going to get to work here. I got this is quite a few problems to work. Before I get started, though, let me hide my meeting controls here. Okay, good. I provide my class with this kind of simple summary sheet of deferred tax assets and deferred tax liabilities. I do call it sometimes a cheat sheet, but I better not see it on in my class during an exam. That will not be good. So, when you think about, let's just look at this. I start right here. If taxable income is higher than book income, I'm paying more taxes now, but I will pay less taxes later for temporary differences. If taxable income is higher because of permanent differences, ignore it. No deferred tax asset or liability comes from permanent differences. But for temporary differences, where the taxable income is higher than the book income, means I'm going to get future savings on taxes. Hey, that sounds like an asset, deferred tax asset. Conversely, if taxable income is less than book income for temporary differences, means I'm going to pay more taxes in the future. Doesn't that sound like a liability? Yes, deferred tax liability. Throughout my lecture today, I'll be using DTA for deferred tax assets and DTL for liabilities. So what are some examples of DTAs? Warranty, inventory, contingency reserve based on estimated future outlays, which are expensed now, but they're not expensed on the tax side. Therefore, the taxable income is higher than books, becomes a deferred tax asset. On the DTL side, one of the most common one is accelerated depreciation expense. Tax laws allow us to depreciate assets faster. You don't record more the total depreciation, that's the same. But on the income tax side, we record larger amounts in the earlier years of owning an asset. Therefore, taxable income is less than book income now. In the future, it'll be higher. And so it's a deferred tax liability. All right. Valuation allowances. This is where there's uncertainty around future deductible items. And we're going to have to record a reserve or a contra asset account called the valuation allowance. And so if we increase the valuation allowance, that's a credit the valuation allowance, debit to expense. If for some reason the estimates we made for valuation allowances last year were too high, and this year we need to reduce the valuation allowance, then I'm going to debit the valuation allowance and credit expense reduction in income tax expense. So dollar for change. Permanent differences, items on the books that will never be recognized on tax return, or items on a tax return that'll never be recognized on books, permanent. So there are no DTAs and DTLs because they don't reverse around. With that, let's get started, because this is exercise 16.6 from the book. But here is one of the challenges for this material. Grab my water. I've been talking all morning about deferred taxes, recording these lectures. So that's not easy on the voice, that's for sure. So one of the hardships with this is you got to look at each item and you got to understand the tax side and the book side. And then you got to see, is taxable income higher or is book income higher? It's for each one of these. So, or is it a permanent difference? Some things could be a permanent difference. So accrual of a loss contingency. And that tells us here tax deductible when it's paid. So we're going to accrue that into expense now. So therefore, book income is lower, taxable income is higher. We're paying more taxes now, less in the future. DTA. By the way, let's see if I can move these up. Yeah, I got 10 items. Why don't you pause the video and go do these 10 items? See, can you get 90%, 80%? Challenge yourself and think through all of these 10 items. I just gave you 1 out of 10 correct. Let's see if you can get this right. So I'm going to pause just for a second. You got to stop the video because I'm going to keep going. I'm not going to wait here 10 minutes, but you go work this on your own. Pause the video, work it, and then come back. All right, welcome back. So newspaper subscription, taxable when we receive it, but that's not how we do it. And on the book side, it's a deferred revenue item. So therefore, taxable income is going to be higher now, but less compared to the books later. Again, DTA. Prepaid rent, tax deductible when paid, but not for the books, right? We're going to debit prepaid rent, credit cash, and we'll record rent expense as we're using the facility. And so taxable income is going to be lower now because they take that big expense right up front, and it'll be higher in the future. Okay, that's a liability, DTL. Accrued bond interest, tax deductible when paid. So for this one, taxable expense is higher now because we're going to deduct that, and it'll be lower in the future, DTA. Number 5, prepaid insurance. Again, this is tax deductible when paid. Well, so the taxes, that's a deduction right now. More taxes, less taxes paid now, more taxes paid in the future. So that's going to be a DTL. Because again, prepaid, just like prepaid rent, same thing. We're not going to expense it now. We're going to expense that in the future during the term of the insurance policy. Unrealized loss from recording investments at fair value. So we're going to take a loss on the book side, but not on the tax side. They don't allow that. It's only deductible, when you sell it. So therefore, book income is going to be lowered now, and taxable income will be higher. So we'll pay more taxes now, but less in the future. DTA. Warranty expense, man, we've talked a lot about that. Yes, higher expense of the books now. Taxable income is higher now, less in the future. DTA. Advanced rent receipts on an operating lease as the lessor. So as those rent receipts come in, we're going to count that as income on the tax return, but not on the books. So we have more income tax now, but less in the future. DTA. Straight line depreciation for financial reporting, accelerated depreciation for tax purposes. So we're going to record more taxable income now because less taxable income now, there's higher depreciation expenses, but more in the future. DTL. Accrued expense for post-retirement benefits, tax deductible when paid. So again, this one, we are accrual-based accounting on the book side. So we're going to expense it now. Taxable income will therefore be higher now because we're not getting that deduction. We'll get it in the future. So it's waiting for us. DTA. How'd you do? These can be a bit of head turners, if you will. And so you have to kind of think about it. You do get back to, I do like looking at it this way, which is higher, taxable income or book income? If book income's higher now, then get a deferred tax liability because you'll pay more taxes later. If taxable income's higher now, you're paying more taxes now, not later. Again, through the DTL, recording the DTL and recording the DTA, you're trying to match up that income tax expense with the current items on the financial reporting side, regardless of whether taxes, we have a tax deduction or not. All right. Next problem, I got to get this all in gear here, so I'll be ready to go. And 16-1. All right, let me find this here. I don't want to be messing this up along the way. So we're going to start kind of easy here. And so we've got a, pull this over here, pull this closer to me. All right. All right, I'll make sure it's not kind of skewed there. So we've got pre-tax income of 400,000. And they're asking us, number one, what will be our net income? So we'll need this, so we got to go calculate income tax expense. How do we do that? Step one, how much is the income tax payable? And that is income taxes per the tax return. And another way of saying that is taxable income, 250,000 times the tax rate, 35%. Calculator here. $87,500. Step two, what is my change? Remember, this is really important. What is my change in my DTA or DTL? And so we've got a single temporary difference. And there were no, we start with zero. There were no temporary differences at the beginning of the year. So everything happened this year. So we've got with a zero balance. So let's go calculate what the ending balance should be. And it's there's $150,000 difference, and all of it's a temporary difference. Okay, book income is higher. Therefore, I'm going to have I'm going to pay less taxes now because my taxable income is only 250. But that 150 will reverse around. I'll pay more taxes in the future. So I'm going to have a deferred tax liability. See, this is kind of, that last exercise was a good one, trying to understand each of these. So I got deferred tax liability, and that's going to be 150,000 times 35%. $52,500. And then we know income tax expense equals the plug for the journal entry. So let's do our journal entry. Income tax expense. We don't know the answer yet. And we've got to credit our income tax payable. Well, let's just go ahead and we'll do that step by step. Credit income. And we calculated that out is 87,500. And what's a change in the DTL? We started with zero, and we need to be at 52.5 credit. And so I can do that. 52.5 minus 0, 52.5. DTL, 52,500. What's my plug? I got two credits and I need one big debit. So that's going to be 140,000. So question one is, what is net income? pre-tax income, 400,000 minus income tax expense. We just calculated that, 140,000. Net income, which is after taxes, $260,000. I like this kind of question because it brings you back to the financial statements. And when you get lost in the weeds here, because this is what we care about, what's the net income? All right. Second question, what's going to be on the balance sheet? Well, balance sheet is going to have a deferred tax liability of $52,500, and don't forget this income tax payable of $87,500. By the way, this is a current liability, and DTAs and DTLs are always, we don't even think about it, non-current, long-term. That's where they go on the balance sheet. Next. All right. Exercise 16-5. Again, I suggest that you pause the video and try to go work this and then come back and see how you did. Pencil. All right, so it looks like on this problem, we've got warranty expense by estimating, obviously they're doing it correctly, they're estimating what will eventually be paid. But for tax purposes, again, as we know, warranty is only allowed as deducted as an expense when actually you pay it. And so at December 31st, 2018, had a warranty liability of $1 million and taxable income of $75 million. And we had a deferred tax asset of 435 at the beginning of the year. An active tax rate is 40%. Okay, I'm ready to go. One, what's the income tax payable? And we have a taxable income of 75 million. So 75 million times tax rate of 40% equals 30 million. Number two, again, we're going to do, this is a warranty. And so we know that book income is lower now and taxable income is higher now. So we're paying taxes now that will pay less in the future, deferred tax asset. And we're looking for the change in the deferred tax asset. And we already know T account time, the deferred tax asset is 435,000. And we need to go calculate the ending balance. So we're looking for to get to the change, you got to calculate the ending balance. At 12/31, warranty liability equals 1 million, right? And so what is that warranty liability? That's all of the estimated claims less all the estimated future claims minus the claims that have already been paid, right? And so what's left here are just the unpaid amounts. Well, unpaid amounts means they have not been taxed yet. And so they will be when those million get paid, they will get taxed. We'll get a savings, I don't say tax, a deduction on taxes when these claims come in. So that's our deferred tax asset times 40%. So we'll get $1 million of deductions in the future. What are they worth to us? The 40% taxes that we'll save, cash taxes, 400,000. So my deferred tax asset is right now, we want it to be, and we should be at 400,000. We're at a debit of 435. And again, step 2 is about the change, not the final balance. And how much the change? We're going to need a $35,000 credit to DTA. Number 3, step 3, income tax expense. And that's the plug. So income tax expense, don't know yet. And I've got a credit, that's gonna be my debit. And I got a credit to DTA. And I got a credit to income tax payable of 30 million. So what's my income tax expense? What debit do I need? Well, I know what my credits are 30 million and 35,000. So my income tax expense is 30 million 035. Very methodical. Step 1, step 2, step 3. You can absolutely do this. All right, exercise 1611. Again, I would suggest pause the video and then you can work this on your own. All right, welcome back. So we've got Paint Industries here. They have a deferred tax asset account with a balance of 30 million attributed to temporary book tax difference of 75 million. So it makes it easy for us. We don't got to go calculate, they're giving it to us. And at the end of 2018, the temporary difference is 70 million. So it's dropped by 5 million. There are no other temporary differences. Taxable income is 180 and the tax rate is 40%. And they have a value. So we're introducing valuation allowances here. This is a good problem then for the deferred tax asset. Remember, valuation is a contra asset for where it's more likely than not that we're never getting these tax deductions. Maybe we don't have taxable income. For some reason, these things, although we have expenses on the book side, they may not ever appear on the tax return. So we have to record the deferred tax asset as if they were going to, and then book a contra asset to as reserve against a contra asset against those. So let's see what we got here. Step 1, income tax payable. And let's see what our taxable income is, 180 million. Times our tax rate, 40%. And I think that's 72 million. To change in the DTA, we only have a DTA here. And so at the end of the year, we put our DTA, I'm a T account guy. And so at the beginning of the year, it says we had a 30 million. And we need to calculate the end of the year. It tells us that the temporary difference at the end of the year is 70 million times our 40%. Therefore, we need 28 million as the ending balance for the DTA. That's what's going to show up on our balance sheet on the asset side, 28 million. But in the books, we got 30. So we got, what do we do? How do we reduce a $30 million debit to a $28 million debit? We do a credit. And so DTA credit equals 2 million. So these changes, they could be debits or credits. You just get to the change. 3, income tax expense. Now, you could do this as one combined entry. I'm going to do it in 2 entries, maybe make it a little clearer. Let's go do the normal one we do, which is debit income tax expense. And we have a credit to the DTA and credit to the income tax payable. And so the DTA credit is 2 million right there. And income tax payable is 72 million. That's pretty easy. What debit do I need? I've got $74 million in credits. So I need a $74 million debit. But I'm not done yet because we have to take care of this. So really, if you want to think about it, a step 4, if that's better for you, valuation allowance. Now, what's our valuation allowance right now? The beginning of the year, it's going to give us that, I believe, 10 million. And so that's a credit, right? It's offsetting. At the beginning of the year, we had $30 million DTA, and till 10 million of that 30 million is more likely than not that we're not going to get that. And so let's see what the balance should be. All right, assuming, so number 1 is prepare the journal entries, assuming it is more likely than not that the deferred asset will be realized. If it said will not be realized, we'd have to pick up that whole 28 there. But it says all of that 28 million is going to be realized. So our ending deferred valuation allowance needs to be 0. Therefore, how do I take a $10 million credit to 0? I got a $10 million debit. Therefore, I'm going to debit in step 4 the valuation allowance for 10 million, and I'm going to credit income tax expense for 10 million. So what is total income tax expense for the year? Because that's what they're going to ask you on a multiple choice question or in a problem. I've got 74 million debit minus $10 million credit. That's a reduction. Remember, a credit to an expense account is a reduction in expense account equals 64 million. I think easy stuff, very methodical. Income tax payable 1, change in the DTA details 2. Plug, anybody can do that, even me, you know. And then 4, get your valuation allowance right. Now let's look at number 2. The only thing that's changing in number 2 is that it assumes more likely than not that 1/4 of the asset will be realized. And so you got to have to kind of think through this when they, these words, so we have to go redo the valuation allowance. So Again, we started with 10 million, right? Let me make sure I got that right. Yep, 10 million. And now you got to just read these words very carefully. I've seen students get really mixed up and do this the wrong. So 1/4 will be realized. What does that mean? 3/4 will not be realized. And we need a valuation allowance for the items that will not be realized. And we don't use the 30, we look at the ending balance. That's what we're looking at. So what is 3/4 of that? 21 million. So we need a $21 million valuation allowance. What do we have now? 10. So in this example number 2, we need a credit of 11 million. So we would debit income tax expense for 11 million, and we would credit the valuation allowance, 11 million. And that 21 million will, so the deferred tax assets on the books will be only 7 million net on the balance sheet. Back in the footnote, we'll provide all of this detailed information around the deferred tax asset. Now, what was income tax expense in this case? We still start with this 74 million. That doesn't change. What we originally calculated, but now we've got to add, before we subtracted 10 because we had a credit. Now we have to add 11 because we have a debit here. So in this case, income tax expense is 85 million. And that's a big difference from 64 million. So the work that you do at year end between your accounting department and your tax department and your auditors overlooking your shoulder on the valuation allowance matters. The other stuff is relatively straightforward. The valuation allowance is a judgment call, whether you're going to realize these DTAs in the future or not. And so that's whenever you have judgment enter in, your guess of the future might be different than my guess of the future. That might be different than my auditor's guess of the future. And so kind of hard to know. And so it becomes just a great deal of work and also consternation at year end for everybody involved in the valuation allowance. All right, let's go to the next problem. Hope you're getting this now. Let's see. We've got, I think I have 2 more to go. Let me see. No, this is the last one. So again, man, you got to get this now. Go out and work this, be an expert, get your confidence up, work this. If you can't get this one, I want you to go back and redo these, start over again and redo them. All right. I'll pause just for a second, let you pause the video. Okay, let's see what we got here. The following temporary differences existed. So now we're coming at this from the balance sheet side. This is a really good one. What I would absolutely expect my students to be able to do on an exam. There's no question at all. I'd rather them work from the balance sheet. And you see here, you got both the tax basis and the book basis for these. Look at the building and equipment, the carrying amount, that's the book amount, 120. The tax basis is only 90. Why? They've recorded more depreciation up to this point. But by the way, this is going to reverse. They'll report less depreciation in the future. So we'll have higher taxes in the future, DTL. Prepaid insurance. We got the income tax return gets to take that payment for prepaid insurance as an expense now. We record that as an asset now, 50 million, and we will take the expense later again. So the taxable income is lower because they've deducted that prepaid amount of 50 million. These are millions. And so there'll be higher taxes in the future. Higher tax in the future, liability. And then liability for a loss contingency. We've recorded a $25 million loss contingency representing future claims that we'll have to pay. But the tax return only allows us deductions when actually the claims are paid. So in this case, the book income is lower, taxable income is higher, we're paying more taxes now, less in the future, deferred tax asset. And so we, that's how we will go about this when we get there. So, and we have any, let's just make sure there were no temporary differences at the beginning of the year. I like that. We start from zero, so the change makes it a little bit easier. Right up with our process. Step one, income tax payable. So our income tax payable, we say here taxable income was 145 million. On the tax return, times what's the tax rate? 40%. Those are high tax rates. So 145 million. $58 million. Two, we're looking for the changes in DTAs and DTLs. Now, we're lucky because we start with zero. Both start with zero. So the ending balance, in this case, is what will go in our journal entry. So we've got building and equipment, difference equals 30 million. And we know that's going to be a DTL. So 30 million times 40% equals 12 million DTL. See how we went through each one first and decided, is this a DTL or a DTA? And then prepaid expense, it's a difference in the basis, equals 50 million. And we also agreed that that was a DTL. So 50 million times 40% equals 20 million. I mean, that represents, hey, the taxes we'll have to pay in the future on these prepaids that, we're not paying now. So the future taxable amounts, we've got now a $32 million DTL. And then finally, we've got the liability for a loss contingency. Basis on the tax return is zero because they don't have that liability. They don't recognize that. So we've got a $25 million difference. And again, here we agreed that it was a DTA because taxable income is higher now, lower in the future. The 25 million times 40% equals $10 million DTA. And this was a, DTL. So DTL change equals the 12 million plus the 20 million, so equal $32 million credit. We needed a 32 million, we needed a $12 million credit balance. We started with zero, so that's 12. We needed also 20 million for the prepaid insurance credit. We started with zero, so the 12 plus the 20 equals 32 million. And the DTA change, again, both started with zero. and we need to go to 10 million. So $10 million debit. And now we're bringing this thing home. Income tax expense is what they're looking for in this problem. That's a plug. That will be a debit. And then we've got to, let's see what we got here. We got a debit to DTA. $10 million. We've got a credit to the DTL of $32 million. We pick up here. And then we've got a credit to the income tax payable, and that was 58 million in step one. And so what is the plug we need? What debit will make the debits and credits equal? So on one side, I got 70, I got 80 million. No, I got 90 million minus a $10 million debit. I need an $80 million debit. Step three, so easy. I love plugs. That's good. So again, I've got 90 here and I've got 90 here. Answer to the problem is 80 million. Step one, income tax expense equals 80 million. Now, number two is what is a 2018, what is a 2018 net income? So pre-tax income on the books equals 200 million. See that right there? Pre-tax accounting income was 200 million minus tax expense. This is our income statement here. 80 million. Net income, 120 million. So I am done with this lecture. You know, thank God. You know, I don't think, I would imagine that most likely if you're like, unless you're a genius, you're not done. And so I imagine you're gonna have to spend some more time on this. And so I would really, hopefully the lecture helps set you up, if nothing else, what you don't understand. I hope I get through with just a little bit of it. But it is, you know, some of these accounting concepts take time to kind of internalize. So you got to digest it. It's like getting a big gigantic steak in front of you or whatever. And you got to take the bites, you got to chew it, you got to digest it. It may take time for you, but I know you can get there. And it's important to get there because every company, except for non-for-profits, has income tax expense. And you want to make sure you calculate that right. And guess what? This is all about, we're not a cash basis, you know, cash basis accounting, not allowed. And it would be misrepresent what's really happening. And so we're accrual-based accounting. And that's what this whole chapter is about, recording income tax expense on an accrual basis. So with that, again, good luck on digesting this topic. Thank you.